The Bank of England has released its quarterly inflation report and cut its growth forecast for the year. Paul Hollingsworth is UK economist at Capital Economics. Paul, what do you think is behind that cut in the growth forecast? What do you blame it on?
Well, I think the bank have become a little bit more pessimistic about the productivity potential of the UK economy. So over the past couple of years, we've seen the UK's productivity performance be really quite disappointing, and they kept predicting that productivity growth would pick up, and it just hasn't. So I think the bank have sort of used that information and evaluated the prospects for productivity over the next couple of years and decided that the prospects aren't quite as good as they previously thought. And you've got quite a difficult global environment at the moment. The Eurozone remains extremely fragile, and concerns about the political situation in Greece are going to continue to kind of weigh on the UK recovery.
On that productivity issue, what's going on in the labor market that is creating a slowdown?
Well, basically, what you've seen over the past couple of years is rather than firms not hiring or sort of during the recession cutting back on workers, what happened was because wages were so low, firms were choosing to just hire more workers but pay them less money. So output in the economy has been met through strong jobs growth but very weak wage growth. And that's the pattern that we've seen over recent years. But labour market slack has been declining over the past sort of 18 months or so. We've seen unemployment fall all the way down to 5.5% at the moment. So the sort of slack that is in the labour market is being used up. And so as that labour market does tighten and wage growth starts to pick up, you should start to see firms squeezing a bit more out of their workers and meeting output through higher productivity. So that's why the bank do expect productivity growth to pick up from now, just perhaps a little bit slower than they previously thought.
So, Paul, the BOE's Mark Carney said in terms of inflation, that will return to its 2% target range within 2 years. Rate increase, it looks like, may not start until the middle of next year. How confident are you about that timetable? You raised some issues about Greece, for example. What if growth slips?
I think that we can be fairly confident about the UK's growth prospects. So our exposures to Greece, for example, are quite low. Obviously, if it was a prolonged period of uncertainty and instability in the region, then that would have a knock-on effect on the UK. But for now, at least, domestic demand looks very strong. Consumers continue to drive the recovery. They're getting a huge boost from the fall in both energy and food prices that have occurred over the past year. And so, we think that the prospects for the UK's own recovery look pretty healthy, actually. In terms of the timetable for rate rises, I think markets have probably got it about right in that interest rates won't rise until the middle of next year. I mean, the bank are unlikely to raise interest rates whilst inflation is hovering around zero, and that looks likely to be the case for most of the second half of this year. But as Mark Carney today said in the press conference, that once these the sort of downward pressure from oil prices, petrol prices and food prices drop out of that annual comparison, we should start to see inflation pick back up quite quickly. So, towards the end of this year, inflation should be back to around 1%, and it should gradually creep up over the next 2 years towards target. So I think markets are right in expecting interest rates to rise around the middle of next year, but then the subsequent pace of tightening is likely to be extremely slow.
Paul Hollingsworth, thanks so much for your time. We appreciate it.
Thank you.
I'm Rhonda Schaffler for The Street.